All right, everybody, welcome to our Masterclass series. Today, we're going to talk about fees, syndication fees. And just a quick introduction, my name is Sujata Shyam, and I am the founder and CEO of Lux Capital Investment Group. We help educate real estate investors and investors in general on commercial real estate investing. Anytime you get into a new investment space, it takes a while to get comfortable and to understand it. And we should all really only be investing in things that we do understand. And so that's the whole point of this series, is to help other investors gain comfort and understanding in the syndication space, because it's such a powerful way to invest in real estate. So getting ready to dive in, we're going to talk about the fees in syndication investing. We'll touch on a myth that we always touch on because it's important. And we'll talk about how the fees are going to apply in different types of deals. So I do these master classes for you. They're not for me, they're for you, to help everyone really gain a better understanding and educate themselves. This is part of a general education that investors might want to be taking on if they want to get into a new investing space. And so this might be for you if you've tried to invest in syndications before but got cold feet, or if you invested in a syndication before, but maybe it didn't go so well and you feel like you made a mistake, or maybe you just simply feel overwhelmed by all of the information out there. So we're here to simplify it and make it fun and engaging. So today we're going to talk about this one myth that keeps people from investing in syndications, which is that they think they have no control. And it keeps a lot of people sidelined from investing in real estate, especially people who've done active real estate investing and who say, well, I know how to flip a house. I know how to, I'm a landlord already. And, why would I, put my money into someone else's deal and then I have no control over it? And, well, the thing is that you actually have a lot of control in where you put your money. It's kind of like you vote with your dollars. Well, in this case, you're voting with where you decide to put your money. And so you should consider carefully where it is you decide to put your money when you're investing in syndications. It's not something that you should rush into under any circumstance whatsoever. It's true that the deals do fill up, but there's no shortage of good deals. I shouldn't say that there's no shortage of good deals. There are a lot of deals out there, and there will be more deals. And yes, we want to take advantage of the market and where it's going. And we don't want to kind of wait until we're in like a low spell and where, the market is maybe not climbing so much. But we do want to be careful with where we put our money. So that's the whole point of these series too, is just to get you guys comfortable and feeling like really good about where you're putting your money. So that's the main control that you have, is before you invest your dollars. And it's a big thing. Okay, so my name is Suja. Most of you know me. I gained financial independence through real estate investing, first as an active investor and now as a passive investor. And now I love to help people break into the space and understand how to build a passive income portfolio where the assets are backed, where the portfolio is backed by hard assets rather than the stock market, for example, which is, can be a good way to build wealth, but is very volatile and can't usually count on it to win every single year. So any strong investment portfolio is going to have some real estate in it. I will stand by that statement no matter what. So I started Lux Capital 2 years ago. I've been investing in real estate for 10 years. I worked for institutional equity providers. So I come from the institutional world, and then I kind of broke out on my own and am doing it with, other people who are building small real estate firms. So fast forward from 2 years later, now my passive income portfolio includes like many, many doors, thousands of doors. And we've got 250 investors, over 40% repeat investors. And here's some pictures of just everything that's happened the last year with my podcast, site visits, etc. And a quick recap of what we've covered so far in this series: the 3 secrets to control, understanding the key players and key terms, demystifying the capital stack, the 5 ways your money makes money, and understanding the crux of equity growth. And today we're going to be talking about fees. Okay, so let's dive into the meat of the presentation. And just as before we get started, we're not a tax or legal firm. And so there are lots of questions that you are going to want to run by your tax attorney, your tax person, and your attorney. We will answer all the questions that we can for you, but we do not provide tax advisory services or legal advice. Okay, so no one likes fees. It's just kind of doesn't make you feel good to hear that word, fees, and I get it. But why do we have fees? Okay, so we have fees, number one, because we need to make sure that our interests are, as investors, I'm a passive investor first, are aligned with those of our sponsors. And so the key is to make sure that the fees are structured properly, because you definitely don't want to have too many fees. And the whole crux of the thing is you don't want anybody getting rich too fast. Everybody should get rich when the deal actually performs. And that's why we have the fee structure, because the sponsors still need to keep the lights on, and they still need to be able to grow, and so they need some money up front. But then the bulk of the money should come basically at exit through the promote, which is not a fee. So alignment is something that can be created with fees, because if a sponsor can't keep their lights on, if they can't grow, then their interests are not actually aligned with the investors, right? It's too far in the investors' favor. Like, the sponsors need to get some fees up front so that they can keep the lights on, et cetera. Okay. And so then, is your money making a return, or is it being feed to zero? So this is something that I really like about syndications, because usually people are structuring their deals appropriately, although you always want to double check and make sure. Whereas in, like, say, for example, the financial advising world, financial advisors oftentimes are getting paid up front, and they're not getting paid on the back end. So they sell you a product, and they can only sell you what their firm offers. So they're not necessarily aware or even have any understanding or knowledge of deals like syndications or any other types of alternative investment classes. And they get paid up front. And so they're not necessarily invested on the deal actually performing, or the investment actually performing for their investors. And I'm not saying there's anything wrong with the financial advisors themselves, but the structure of how they get paid is not fundamentally supportive to the investor's long-term interest. And so that's what I like about syndications, is that, for me, it's actually like kind of, and for the sponsors, like, it's kind of a waiting game. Like, we actually mostly don't get paid until years down the line. And I think that's how it should be. And so that's why you want to make sure that your money is not getting feed to zero. And part of that is understanding what the market rate for fees are, and seeing how different sponsors are adjusting it. For example, if a sponsor is charging a 5% acquisition fee, that's not market rate. And so that's something, you'll kind of start to understand that over time as you get more experience with these. So you want to make sure that the fees are appropriately structured. And number 3, transparency. Do you understand what your net return is? And so this is big for us, because there is so many complicated fees and waterfall splits and stuff. Whenever I show projections, it's always net of fees. We're always showing projections net of fees, because we just, it's just too much information to process. We want investors to be able to look at it in investment, say, okay, this is what I'm projected to get in year 1, 2, 3, 4, and 5, and not have to worry about subtracting this fee or that fee or whatever. So that said, if you want to understand all of the fees that are, and you should, be curious about that, then make sure to either ask or look for it in the presentation, also called the offering memorandum. That's just one of the lingos. When the offering memorandum is the word for, kind of another word for that is investment deck, or executive summary, or project summary. So offering memorandum is kind of like the technical term for, like, the major marketing PDF document. And it should include fees. And that, I'll add one caveat in there, and that is that because what I do as Lux Capital, we're actually, we're our goal is to provide our investors with a diversified set of offerings across asset classes, geographies, and operators. So we usually just display the fees at our level, and we don't usually put in the fees that the sponsor is charging, but we can always share that with you. The reason we don't put it in our offering memorandum is just to not confuse people, and because the net fees are, or the projections are net of all fees. And yes, but the more you understand it and the more you want to know, I'm always available to ask any questions. And you should always feel free to ask questions to your sponsor, because transparency is something that all sponsors should be striving for. They should, in my opinion, want their investors to understand exactly what it is they're investing, exactly how the money flows and who's getting paid what. And it's just something that is important to me, and it should be important, in my opinion, to anybody who you're putting your money with. Okay, so who gets the fees? So number one, the sponsor gets the fees. So the sponsor, also called the operating partner, also called the general partner, they are getting certain fees. Okay. And then Lux Capital, that's my firm. And we're gathering investors, we're investing as a group, we're getting preferential treatment, meaning better terms, better rates, a bigger split of the pie whenever possible. So we also take some fees so that, I can operate, et cetera. So those are the two groups that are going to get fees. And again, I just want to reiterate that the projections, also called the pro forma, are always shown net of fees and cash flow splits. So what's the difference between a fee and a cash flow split? So a fee is an above the line expense, and a cash flow split, also called the promote, are below the line expenses. So those the cash flow / promote will come out of distributable cash flow, which we went over last week. We touched on it last week. So distributable cash flow is kind of the profits of the deal, so to speak. Fees are an expense to the project. So, okay, so now let's go over types of fees. So there are many different types of fees that could be charged in a syndication. Some are more common than others. And usually not all of them are going to be in any one given circumstance, but there are situations in which a sponsor would charge more than like a typical amount because they're vertically integrated. We'll go into that in a second, but let's just talk about some of the types of fees that there are. Okay, so the acquisition fee is a common fee that you will see. And it is typically between 1% to 3% of the purchase price of the property. And so, for example, if it's a $10 million project and we're raising $4 million, then the acquisition fee is 2%, then it's going to be 2% times $10 million because the purchase price is $10 million. Okay, so the asset management fee, so that's the acquisition fee, is a one-time fee, and it gets paid at closing. And usually it allows the sponsor to, it shouldn't be too much. Like a 5% acquisition fee, you should be raising your eyebrows and asking, why are you charging a 5% acquisition fee? Okay, number 2, asset management fee. So the asset management fee is the fee that is charged, that the sponsor charges to continue to operate the property and make sure that it is performing well. And so it's different than the property management fee, because the property manager is really handling the day-to-day, and the asset manager is basically managing the property manager. And so the asset manager has to make a lot of the major decisions about like how to spend the capital expenditure budget, and what the priorities should be in terms of budget and where to put money, and what the business plan should be and how to execute it and when. So the asset management group is really making a lot of decisions and driving the business plan and handling problems. They're ultimately the ones who are responsible for making sure that problems are handled, right? So whereas the property manager is the one and we rely on the property managers, and we want really good property managers, but the property manager is the one who's executing the business plan and carrying out the plan that the asset managers are putting into place. They're not necessarily making big decisions on, okay, what's the finish going to be, and what are we going to be, how much money are we going to spend per unit, and are we going to spend money on signage or the pool, or how are we going to split the budget? So the asset managers are going to split that fee, are going to make those big decisions, and the sponsor gets paid usually 1 to 2% of the gross income. So that's an ongoing fee that's paid out, on an ongoing basis. Sometimes sponsors will charge a construction management fee, which is typically 5 to 10% of the total planned budget. And so that's when there's like major renovations that are coming out. So like if you are actually going to be managing the general contractors, rather than just, sometimes the property managers will be the ones carrying out the construction management, but if the sponsor is the one carrying out the construction management, then they may charge a fee of the construction of the total planned construction budget. And yeah, an equity placement fee is typically 1 to 2% of the total investor capital that is charged, that is raised. So it's kind of different than the acquisition fee. We call it the equity placement fee, and it's would be paid at closing, and is typically 1 to 2%. So it would basically be a lot less than the acquisition fee because it's just on the equity raised. So, in this example, we said $10 million property, $4 million equity raised. So in that case, the equity placement fee would be 1 to 2% of $4 million. Okay, other types of fees. So the loan fee. So oftentimes the loan fee will be between 1 to 2% of the total loan amount. So it's a one-time fee, and it is paid. Sometimes it's paid to the key principal. Sometimes there are sponsors who need to bring on a key principal to guarantee the loan, and they're going to use all their assets to guarantee the loan. And so that key principal will get paid potentially 1%. So like, for example, if I'm just getting started and I want to do a $10 million property, and I found a great deal and I have the team in place, but the bank won't give me a loan because I don't have enough assets to guarantee the loan, then I can bring in somebody who, knows the project, knows me, likes the deal, and has assets. And I can say, hey, maybe it's my dad. Hey, dad, will you be the key principal on this loan? And then I would pay him 1% or 2% to basically sign on the line and say, okay, I will, back this loan with all of my assets. And so sometimes sponsors have enough liquidity and have enough assets that they can back the loan themselves. And so they'll still take a fee for that because, they would have had to pay somebody anyways to do that. And it's just kind of something that it's a project expense that we need to be able to get these loans. And so we need to compensate whoever is able to sign on the line and put all of their assets behind the project. So that's the loan fee. And so sometimes you'll see that going to the key principal, and sometimes you'll see that going to the sponsor. Okay, a refinance fee is typically between 1 and 2% of the total refinance loan amount. So oftentimes sponsors will refinance the property as soon as they can, really, because they want to return investor capital as quickly as possible to increase the velocity of capital and to increase the IRR, and to help take advantage of the time value of money and get that. If we can get that equity back into the hands of the investors, then they can put it into another project and get their money working for them faster and faster. And so the refinance is, it can be a fair amount of work to process a refinance. It's like, if you've ever gotten a home loan, it's like a part-time job, just making sure that you get all the documents in place in order to purchase your home. And so the refinance fee is something that, is an additional incentive for the sponsor to be able to just get compensated for their time that it takes to do the refinance. And then a disposition fee is another one-time fee that is sometimes taken on sale. And it's just another way that the sponsor is getting compensated can get compensated for performing on the asset. And so, rather than take a 5% acquisition fee, they're splitting it up. And so they're taking potentially a 2% acquisition fee and then a 2% disposition fee. And that way, their interests are more aligned with the investors because they obviously don't get the disposition fee until the project sells. So that's another fee that you'll probably see on a lot of projects. Development fee. So a development fee is less common. It happens when the sponsor is actually doing development work. So if it's a new construction project, if there is new construction happening, like so sometimes with our self-storage deals, we're adding projects to the we're adding square footage, and so we're developing new square footage of self-storage, and so the sponsor will take a development fee. And this is a typical fee. So sometimes they'll hire a developer to get all of it done. But if they're a vertically integrated property and they're going to handle the development in-house, then up to 10% is pretty standard amount for a development fee. And next we have the property management fee. So again, this will only apply if the sponsor is vertically integrated and if they handle property management in-house. If they hire a property manager, then they would just pay the property manager, probably not 10%, but maybe 3 to 5, 6, 7, 8%, depending on the size of the property and other factors. But if the sponsor is vertically integrated, like for example, one of the groups that we work with in self-storage, they are vertically integrated. And so they do charge a property management fee that's market rate. And of course, we're making sure that they're charging a fee that's market rate. And, the property management is kind of the boots on the ground. That's kind of where a lot of the really important work happens on the day-to-day, making sure the property is operating well, making sure people are paying rents, making sure things are just basically being handled. So, yeah, a couple notes about fees. So you're not going to typically see all of these fees on one project. It is rare for an investment to have more than 4 fees unless the sponsor is vertically integrated and they are handling a lot of the other aspects of the project, right? So it's important to be able to understand the different types of fees so you can contextualize, okay, is this a lot of fees? Is this not a lot of fees? And if you don't understand the fees, feel free to ask your sponsor for a clarification and an explanation. It's something they should be willing to talk to you freely about. And, understanding fees is a critical part of understanding what it is that you're investing in. So feel free to ask questions about that anytime. Okay, so what do we do? One additional nuance that I touched on before is that the sponsor has fees, and then we have some fees, and we have a lot fewer fees because we're not doing the operations. But let's talk about a previous example. It's a project that we just recently did. This was a self-storage project, and the fees that are being paid to the sponsor in this project is a self-storage project where we are developing additional square footage and where the property manager is part of the sponsor group. So in this case, the sponsor is getting paid an acquisition fee of 2.85%, and they're getting paid a development fee of up to 10%. So they haven't decided how much they're going to pay themselves. They don't know exactly how much how much space they're going to be developing, but they're budgeting up to 10%, which is market rate. So, we're okay with that. And they're also charging a 6% property management fee. And because they're vertically integrated, they're only charging a 0.25% asset management fee, which is pretty low. Oftentimes you'll see an asset management fee of 2%, but because they're vertically integrated, they're weighting it more heavily towards property management. They're charging themselves a 2% disposition fee. So again, that aligns with the interests of the investors because they're going to get paid that once we sell. And so they're not getting that paid the disposition fee up front. And so that's something to look for, are they getting paid a 5% acquisition fee? No, they're getting paid a 3% acquisition fee, or 2.85 in this case. And then they're putting a 2% disposition fee on it. And then there's the general contractor fee. So, this is another thing. It seems like, well, but aren't they getting a development fee? Well, with construction projects, you have to pay a general contractor, you have to pay a developer. There's all these people that you have to pay. It's actually kind of mind-boggling when you look at an actual development pro forma and look at all of the different costs that there are. And so it is definitely market rate to have a general contractor fee of up to 10%. And then their financing fee is 1%. So that's their fee for putting the capital stack together, meaning the loan, the equity, or guaranteeing the loan, etc. So that's an example of a previous project that we just did a few months ago. And then, again, I just want to mention that, the sponsor is often also referred to as the operator or the general partner. And so getting a handle on all this language will start to help things make more sense to you. Okay, so then what do we do? So what does Lux Capital get paid? So typically we are beginning to charge an acquisition fee, typically 1 to 2% of the capital invested. So not the project cost, but the capital invested. And, that partially covers our legal expenses, or usually that's covering our legal expenses, and then just putting a little bit of money in our pocket so that we can keep the lights on. But the key is that we're not getting rich too fast, right? And so that's something you always want to kind of keep your mind on. So it's like, you might even do the math in your head. Like if the raise on this deal is $1 million and we're charging a 2% acquisition fee, then that means that we're getting paid $20,000 at closing. And of course we have legal, which costs probably like $7,500 to $10,000. And so that means that we're getting just $10,000, right? And so that's, in my opinion, just enough to keep the lights on, basically. And then we're getting an asset management fee of about, usually, then this could change deal to deal, but we're currently charging 0.5% of the total capital invested annually. So I'm just going to put that in. So that's, again, if it's on $1 million raise, for example, then that would be $5,000. And so we, in addition, mostly that just covers our expenses. We've got to file our taxes and do our K1s and pay our various fees, like, for our registered agent and to the state of, Wyoming, where we're incorporated, and things like that. And so it's just really results in like a few extra $1,000s in income per year per deal. So that's typically what we do. And then those are expenses to the property. And then after that, that's when the cash flow happens. So that's when we initiate cash flow and the charts that you've seen. Okay. And so after the fees is the waterfall split. So that's also important to understand, is that the fees are above the line expenses. So they're expenses to the project. And again, something I want to note about the Lux Capital fees is that they're quite low compared to the sponsor fees. And that's because the sponsor's doing the heavy lift. And the other thing is that the reason we're able to charge these fees is because we're usually negotiating preferential treatment. So we're investing as a group, we're writing a big check to them for, $1, $2, $3, $4 million. And that means that they are happy to give us extra return. So extra piece of the deal, extra, they might help us with our legal fees. They might share their acquisition fee with us. So there's different ways of structuring it. And our goal is to make it as advantageous to the investors and ourselves and the sponsors as possible. The key is that we all want to have a good time together, where we want to structure the deals properly so that, everybody's happy and everybody's making money, etc. So, so that's how so when we say we charge, an acquisition fee, usually we are able to take some of that from the sponsor's acquisition fee, or it kind of balances out because we're getting a bigger piece on the back end. And so it just balances everything out. And so every deal is going to look a little different. I'm always happy to go over the spreadsheets with any individual investor. Usually it's not something I'm going to go over in, the webinar, just because it's kind of in the weeds. But if anybody's curious about how that works, I'm always happy to go over it with you. And so, yeah, so that brings me to after the waterfall split. So the promote, this is another word for the way that the sponsor gets compensated for as part of the upside of the deal. So like overperforming the deal. So the promote or is not a fee. It comes from distributable cash flow, and it comes after the investor has gotten their preferred returns. So you'll see promotes anywhere from 50-50, 50 split 50-50 to 90-10. I mean, I have seen 195-5, and that's really, that's, you know, but that's not as common. And so it depends on how much the work the sponsor is doing and other factors. Like, for example, another factor might be, are we getting a bigger piece of the pie because we're investing as a group? So the promote is really how the sponsor gets most of the upside of the deal, right? Like that's why we're really in it together. Like we need to charge the fees in order to kind of help us, you know, get paid during the life of the hold period and during construction, et cetera. But the promote is really, you know, where the real money is. And that's really why, you know, why these deals are, I like the way these deals are structured, because no one really gets rich until they promote, right? Until people actually start making money, until after the investors get their preferred return, et cetera. So, yeah, let's see. Now I'll go to the next one. Okay. Yeah. So that's pretty much all I wanted to cover today. I would love to know if anybody has any questions, if this has been helpful. So please feel free to put them in the chat. I haven't got any questions in the chat yet. And in the meantime, if you're tuning in for the first time, please feel free to join the Lux Capital Investor Group. And, you know, that way you can get access to all of our deals and start to learn more about what it is that, what offerings we have coming up. Was this helpful? Oh, I got a question. Super helpful.
Last week I had asked you, I think I'd sent you an email asking you about the fee range for one of those categories. I can't remember which one it was, but you answered it here. So yes, I found it very helpful.
Oh, great. I'm so sorry I missed that email, Jennifer.
That's okay. Not a problem. It's a busy time right now.
I know. Yeah. Feel free to always ping me again if I missed another question. Okay. Well, I'm glad to hear that that was helpful. Again, you know, transparency is a huge goal of mine. And so want to make sure you guys really understand what you're getting into. So feel free to reach out anytime with any questions. And yeah, if you haven't yet joined the Lux Capital Investor Club, it's for people who are just starting out. It's for people who are a pro investor. It's for people who are doing this on the side, or if you're doing this full time, if you haven't invested in a deal, or if you've invested in several deals. So I really am catering both to beginners as well as to experienced investors. And yeah, let me know what topics you want covered. You know, these deals, these investments are for you. And I want to make, I mean, not investments, these masterclasses are for you. And I want to make sure that we're helping demystify this whole world of investing. So please feel free to shoot me an email if there's anything you want to see covered. I'm going to keep trying to cover the basics and higher level concepts as well. So thanks so much, everybody. All right. Well, I'm going to keep it nice and short today. And yeah, we'll see you next time.